Welcome to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia Defusing, joined today by Jordan Main, president of Main Financial Group, as well as joined by Adam Freund, CRC of Main Financial Group. And to our viewers at home, we welcome you. Thank you, viewers in the Detroit area. Thank you for always spending time with us. We're going to talk a little bit today about diffusing the retirement tax bomb. And there's a reason behind it. When you think about retirement, you're obviously thinking about savings and putting money away. But what happens when you start pulling that money out? Could it be a tax time bomb? Where is it hiding? What can we do about it? That's what today's show is all about. So again, viewers in Detroit, thank you for being with us. Jordan, how are you?
Oh, very excited. This is a topic very near and dear to my heart, getting rid of taxes. So I'm excited for today.
Yes, I know it is. I am fantastic. Thank you so much for asking. And Adam, how are you?
I'm feeling a little conservative, but I might get more aggressive as this show goes.
Oh, excellent. All right. We're going to get you like...
I can hear the audience.
Right. Yeah. Okay. Well, moving on. We are going to talk about identifying the problem. And what really is identifying the problem? The tax bomb. Wow, when you think about this, Jordan, I want to start with you because obviously people are starting to put money away, and that's what they're focused on all through retirement. They start early and they're working all the way up. But there's something that's a silent partner, and there's some lurking that's going on. Talk a little bit about that, the retirement tax bomb.
Yeah, the retirement tax bomb right here. Uncle Sam is your partner in all these retirement accounts. And it really doesn't seem like an issue for people until they start getting close to retirement. You kind of put money out of your paycheck into your retirement accounts. And now as you get close to retirement and you're doing planning, well, wait a minute. This is taxable?
Yeah.
And it really is just an IOU to the IRS, right?
Absolutely.
These IRAs,
100%.
forgive all the acronyms. But, you know, at the end of the day, when this started back in the creation of the ERISA, right, back in the 70s, Employee Retirement Investment Savings Act, it was put money in a tax-deferred account. So we get a deduction now, a small deduction now, and then as that money grows, you pay tax later. The idea or the myth was that when you pull money out in retirement, you'll be in a lower tax bracket, right? Well, we've got several things to go over today that show that that really isn't the case anymore. And an argument of why getting a little deduction now for a lot of tax later might not be the best strategy.
And can I just interject here too?
I guess so.
The whole idea is that, I'm going to be putting money into the account, right? Putting money into the account. Plus, we're going to have the money grow and grow and grow. Uncle Sam, he loves that. He loves the fact that you continue to grow your account. Who wouldn't want $1 million in their IRA account?
True.
$2 million in their IRA account.
Every time another zero is added to a retirement account, that's more taxation that the IRS is going to get.
Yeah.
So they're very profitable vehicles for Uncle Sam. There are a lot of other strategies that we can get rid of that, but it's been a big shift in the retirement planning world, definitely for the last decade, but since COVID, even more focus on tax reduction strategies.
100%.
Wow. And so I'm thinking to myself, we've been taught this over and over again. Go ahead, put all your money in or as much as you can without realizing that this is definitely a hidden tax liability. And the average person doesn't usually realize that it impacts them over time. So when you think about it, I want to talk a little bit about something called the RMDs, required minimum distributions. Start to expose this problem when someone reaches retirement. How does taxes marry into that? And why is that something that is hidden until people realize, whoa, I'm not ready for this?
Yeah. Well, actually, it's funny. We just met with somebody who watched us on a previous show who came in. And right now, they're in a relatively low tax bracket. Okay. 12% tax bracket. They're keeping their spending under wraps. They live within their means, but they're fast approaching, for them, 73. And that is when the dreaded required minimum distribution comes in.
Which is essentially forced withdrawals.
Yep.
Right. What does that mean? That means that the IRS is going to make you pull money out of your retirement account. Why? So you have to pay tax on it.
They want to get paid.
But the problem is the snowball effect that now brings, right? So if we take out income that we don't need, unnecessary income, we're going to trigger higher tax brackets.
Yeah.
But wait a minute, we also might trigger other taxes. Social Security may become taxable at a higher rate. Medicare, or they call them IRMA surcharges, could now increase the cost of what you're paying for Medicare. So it's kind of like, it isn't just one problem, it's another problem and another problem. So managing your tax brackets in retirement is the key to get through retirement.
Right.
Most definitely. And how often do people not plan for taxes, Adam? I want to ask you that question. Are people just busy working and they're not thinking about it and they don't even really know that they should be doing it?
Yeah.
But do you see that often where people are just not planning?
Almost all the time.
Yeah.
I mean, this happens to us all the time. We see people come in and they have saved and saved and saved, and they think they have this giant amount of money, which they do. I mean, let's face it, $1 million is $1 million, but it's not all yours. And that's the issue. If they're planning on their retirement based on that $1 million, $1.5 million, $2 million, and it's all sitting in an IRA, I'm sorry, you have a business partner that you didn't realize. And part of the thing is that we've been taught to, put it into your 401k.
Defer. Right.
And there is an argument to be made. Now, you don't want to miss out on your matching, but there's an argument to be made that maybe not putting money into that, but putting it elsewhere.
Right. The myth also is that when you're retired, you're going to have a lower tax bracket, right? Well, let's walk through why that's not the case. All your majority of your deductions are gone in retirement. Your children are gone and off. You maybe paid off your house. You're not maybe donating as much to charity, which is a deduction in retirement. Okay. So you've lost a lot of deductions, number one. Number two, look at how active retirement is. We've, for many years, joked about pickleball on this show, right? $1 billion business. Retirees are more active. They're spending more money. Yeah. Throw that on top of inflation over the last 7, 8, 9 years, and you can't live on Social Security alone. That's almost at welfare stage, right? So we need more income in retirement, which triggers more taxation, and all of a sudden now tax planning becomes the number one issue in retirement planning as far as I see.
Yep.
Most definitely. Well, Jordan, I know that you have a very special message to the viewers at home. Talk about what that is today. We're going to take a commercial break, but what should they do to take action and to stop this tax bomb from exploding in their laps, if you will?
Absolutely. We're offering today anyone that calls in or clicks on the scan to get their own personal written financial plan. We call it the RIP report, R-I-P-T. We think there are 4 key areas in everyone's financial plan you should have. A risk valuation, how fast or slow are you driving your portfolio? The I is for income. Do you have an income plan or is it more of an income guess? We can help roadmap that out for you. The P is the health of your portfolio. What are we paying in fees? How are your returns doing? And lastly is the T, which is taxation, which we're talking about in the show today. Do you have a tax reduction or mitigation strategy in retirement? We can show you several ways on how to do it.
Jordan, thank you so much. Adam, thank you so much. To our viewers at home, once again, it's time for you to take action and defuse this tax bomb. How do you do that? Call in 888-462-7839, 888-462-7839, or grab your smartphone and click on the QR code at the bottom corner of your screen. That's going to be the fast track to get on the schedule at Main Financial Group. Well, we talked about the hidden tax bomb and how it can derail your retirement and explode if not prepared for. So, what are some solutions? How do you defuse the tax time bomb? Stay tuned. We're going to talk about that momentarily. Don't go anywhere. I have so much more to come.
I was an accountant by trade out of school, out of Michigan State, and I absolutely hated brokers, financial advisors, whatever they wanted to call themselves. I was a tax accountant, and we would share a mutual client. And this broker would advise our mutual client to buy, sell, and never do any tax strategy. And I was left to clean up the mess. So I went to the client and said, please talk to your broker and tell him to knock this off or begin to do some strategy. And the typical broker response was, I'm not licensed to do that. I can't talk about taxes. So I basically decided to get my investment securities license and all my other licenses out of spite so that we could do all the tax planning as part of the investment strategy for our clients. The value of choice, as we always say, if you go to a big box firm, they're going to have one of 6 portfolios, let's say, and you're going to fit into one of those. The value of working with an independent advisor, especially a fiduciary like we are, is that they have to do what's in your best interest, and they can use any program that's licensed out there in America. So a huge difference. After 20 plus years on this side of the fence, I think our industry does a poor job at explaining to the public the difference of those two. I come from a culture of helping people and educating them, not just telling them what to do. So I think people that truly want to educate make a big difference in this industry.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Main Financial Group. And what we're talking about today is the tax time bomb. And think about this. You've been working, you've been saving money, and all of a sudden, when you think about it, how it comes out can be taxed. This can be derailing if you're not prepared. So thank you for being with us. And gentlemen, I love the fact that we're going to offer some solutions right now for the retirees, because people I know are leaning in and they're going, what can I do to prevent this? So that is my question. When it comes to lowering taxes in retirement, what strategies should people be thinking about? And do Roth conversions play a role? I know people are curious about the Roth.
Yeah, I think it starts where you've got to understand. No, I'm good.
Okay.
There are three really basic types of tax buckets, right? Yeah. All of our investments go into one of these three buckets. And we have a tax bucket that what we call pre-tax, that everything goes in pre-tax, but it's in 100% tax deferred. Yeah, we've got it up on the screen for you. Then the middle bucket is what we call taxable. You pay taxes out of your paycheck to get it. You then invest it into a CD, and now you pay taxes again at the end of the year. Double whammy there in the middle bucket. The last bucket, zero taxation. Those are our Roth IRAs that you alluded to. So the whole idea, as you see on the screen, Cynthia, is we want to try to get dollars from the first bucket, which is the BOMB, the tax bomb, all the way over into the tax-free bucket on the right. And we've got a couple little tricks on how to do that.
Well, one of the things I wanted to point out in this graphic is, if you notice, the way we've done this is, where do most people have their money?
Tax deferred.
Tax deferred.
Yes.
We have been all trained to do this since I think you said.
And 100% of everything in that bucket, when you pull it out, is ordinary income, as it says there. It isn't a capital gain, or you can't write off losses. It's all income to you.
Now, if you guys can tell me where your tax rate or your tax bracket is going to be in 3 years from now, 4 years from now, 10 years from now, depending on how old you are, well, you have a crystal ball in front of you that we don't know. So what are some of the solutions?
Well, I mean, if you look at it right now, tax rates are the third lowest in history. Right? Taxes are on sale. Like if you look at the history back in 1944, the highest tax bracket was 94%. Then in the 60s, it went to 82. Then in the 70s to 70. And now the top bracket is only in the high 30s, and it's up near almost $800,000. It's shy of that. So the idea is, it's a taxable event to move money from your pre-tax bucket to your Roth. But you need to do it intelligently and not waste much tax or too much tax. So we developed an online calculator, Cynthia, a free tool. It's called MainTaxBill.com. Anyone can go out and use it. Very, very simple to use. And it's a Roth IRA calculator. It can help you solve the problem we're talking about today. Right. And Adam and I, before we came, we ran a couple scenarios. And I think we've got a graphic to put up. First, we took a 65-year-old. And this is right off the MainTaxBill.com. And we said, what if they had $1 million, and you can pick whatever tax liability you want. In this case, we choose 25%, and you can assume whatever growth rate you want. We chose 5%. And as we talked about in the first segment, there are RMDs that kick in your 70s. So if we look at that $1 million IRA at age 65, if they live to be 95, they'll pay $510,000 in taxes on their RMD withdrawals.
Wow.
Next, the software takes those withdrawals, net of tax, and invests them back in an after-tax account at the rate of return you pick,
5%.
Which we picked 5%. And over that same 30 years, there's another $209,000 of tax due. Then upon death, anything left in the IRA is still taxable. And in that case, you see it's another $266,000. So that $1 million IRA left in it alone, not converted to a Roth, will cost the client $986,000 in tax if they live to age 95.
You're left with nothing.
And let's just say one thing real quick. 25% and 5% is very conservative.
Yes.
Yeah, very
conservative.
Yes.
Right, and you can go through on this calculator, this tool, and it's free. Do as many scenarios as you want. We then used it for a 10-year younger person, and it gets even uglier. So now we've got a 55-year-old with the same $1 million and the same factors, and now look at, we've got $831,000 of tax due just on the RMDs, and then another $340 of taxes on the growth of those RMDs invested, and then at death another $434,000 of death tax. That is $1.6 million in taxes if you leave it. Versus on both these scenarios,
Yes.
if we convert to a Roth IRA at 25%, I'm not great at math, but what's $1 million times 25%?
Wait a second. I got a calculator around
That's
here.
$250,000. Now, you would have to do it over a couple, 2-3 years to stay in that 25% bracket if you choose that bracket in the calculator tool. But the concept is still there.
Yes.
So for the 65-year-old, $986 in taxes or $250 in taxes. That's about a $700,000 savings.
So you and I do this a lot, right? We talk to our clients a lot. We talk to the people a lot, right? Why do you think that they're still so hesitant to do it right then and there?
Well, there's an emotional thing of causing taxation and saying, boy, I'm going to move $1 million over 3 years into a Roth IRA, and we're going to trigger $250,000 in tax. That's hard to get through emotionally and mentally. But when you look at the flip side, that's going to save you $700,000 in tax.
Wow.
Who wouldn't do that?
Who wouldn't?
And then how about on the 55-year-old? It was 1.6 owed in taxes versus $250 owed in taxes on the same $1 million. That's a 1.3 roughly tax savings just by recategorizing your assets from pre-tax to after-tax. Third lowest tax environment in history. Taxes are on sale. Look at Roth conversions.
I think people need to actually physically see the numbers. Like, I don't know if you're a visual learner at home, I know I am. When you put it up there on the graphic so we could see it, it makes perfect sense, but people are probably thinking, what does that look like for me? I don't understand. Again, we invite you, go to maintaxbill.com, maintaxbill.com. You can play around with income levels, you can play around with tax brackets. We think you'll be very surprised to see what your current tax burden is today. So again, we invite you, maintaxbill.com. So gentlemen, viewers are probably wondering, when should I start implementing these strategies? What is the perfect timeline? What is the perfect age? How do you help predict?
Well, if you look at the two scenarios we just showed, the difference in savings from someone at 65 that started their tax planning versus someone at 55 that started their planning.
Yes.
It was it was a savings of 1.3 million versus 700. That was a $600,000 savings. So the younger you are, the better. But even if you are 85 years old, in the next segment, we're going to talk about some strategies as well that you can still reduce your taxation to you and your family. I don't think it's ever too late or it's ever too soon, if that makes sense.
Yes,
it does.
Agree.
Makes perfect sense.
Yeah.
I
He gets
love
paid
that
the
you
big
both
bucks
agree.
for that comment.
I love it.
We agree. What's going on
You
here?
remind me of Ed McMahon.
Yes.
That is correct.
Yes.
Well, Jordan, let's invite the viewers to get ripped. What do you think?
I love it. Get ripped. Call in right now. We'll give you your own personalized written financial plan. 4 key areas, the RIPT, risk, make sure you're driving as slow or fast as you want in your portfolio. We're going to create an income plan, not an income guess. P, will make sure your portfolio is healthy and in all the right sectors that you want. And most importantly today, we'll get you a tax plan to get Uncle Sam out of your pocketbook. We'll also throw in a copy of our new book that came out at the end of 25, Main Street Millionaire, How Real People Build Real Wealth and Keep It. It's a great financial planning guide. So call the number or click the scan.
Jordan, thank you so much. Adam, thank you so much. To our viewers at home, once again, the number to call in is 888-462-7839. Or we invite you to grab your smartphone and simply click on the QR code that you see on your screen. That is going to be the fast track to get on the schedule of Main Financial Group. When we come back very shortly, it's not going to be that long, we're going to talk about legacy planning. What happens with some of these tax strategies, and what if they're not utilized when you're thinking about passing along wealth to future generations? Stay tuned. You're not going to want to miss that. We'll be right back.
A recent MarketWatch story followed a 63-year-old who had everything mapped out for an early retirement until the market dropped. Overnight, his confidence was shaken. Years of saving and planning suddenly felt uncertain.
It's a familiar story, especially when headlines are filled with volatility and downturns. But the truth is, retirement doesn't have to hinge on market timing.
With the right plan, you can build a retirement strategy that prepares for uncertainty. It's about balance, growth for the future, protection for now, and a flexible income strategy to help you stay the course.
The markets may fluctuate, but your retirement doesn't have to. A diversified strategy built around your lifestyle and goals can help you retire and stay retired.
Welcome back to the Main Money Show, where Wall Street meets Main Street. My name is Cynthia DeFazio, joined today by Jordan Main and Adam Freund of Main Financial Group, and we're talking about how you can diffuse the tax time bomb. It could be ticking, and you're not even realizing it. We're talking about some actions to take today. And in this next segment, we're going to talk about legacy planning. What is the impact on future generations? And gentlemen, I love that we talk in between the segments, if you will, and you mentioned something that I'm so curious about, the IRA legacy strategy. What exactly is that? Because I know the viewers at home are now leaning in saying, I cannot wait to hear.
I hope you are leaning in to listen to this part, because this is something that, well, you just don't want to do with your kids, right?
Oh, the worst thing you can do financially for your children is give them your retirement account.
Oh, what?
And that was a dramatic pause, but
Yeah.
it was intended.
It was.
Yeah, we use the analogy of, throwing a wedding for your daughter, and we both have daughters, and
Yes.
at the daddy-daughter dance, and your daughter says, Daddy, it was such a beautiful, perfect evening. Thank you so much for this wedding. And you say, you're welcome, honey. And by the way, here's the bill that goes with it. And that's what you're doing when you give your retirement account to your kids. You're giving them a giant tax bill because they pay income tax at their level on your retirement, which could jack up their retirement, their bracket, their tax bracket of what they're paying on their current salary. And it's going to waste a lot of tax dollars. So what we say, if you don't need some or all of your retirement, don't just give it to your kids. Put it into what we call an IRA legacy plan. And I can talk to this specifically. This happened in our family, right? So my dad passed away in 12. He was a school teacher, 2012. He had about $500,000 in what's called a 403B, which is like a retirement account. And mom was also a school teacher, retired, pension, had her own 403B. She didn't need dad's retirement account. No. She said, I'm just going to give it to you, your brother, and your sister. So the three of us would split that taxable income to us. Maybe we net $350, so maybe a little over $100,000 each. I said, Mom, we're not doing that. We're going to keep it in your name, and we're going to reposition it into an IRA legacy plan. It's got a couple different features, but ultimately, there's a life insurance trust part of it that Mom went through an underwriting, and we were able to get $2 million of tax-free death benefit in the IRA legacy plan. So that $500,000, which was going to be taxable to me and my brother and sister, now is not taxable and is put into a program that now pays out $2 million upon Mom's death. So that one unit of money we took from netting $350 to $2 million with no implication on our tax bracket.
So you took $500,000 and turned it into $2 million.
Correct. $500,000 before tax.
Yeah, before tax.
Right.
Yeah.
But it even gets better if there's a husband and wife, if there's a married couple.
Yeah, we actually have real world example of
We
that.
do. So we had a 65-year-old that had the same $500,000. And there were two people. So we took the IRA legacy and put it into a joint program and a joint trust, life insurance trust. They were able to get $5.5 million in that policy. So it's one policy, one life insurance policy on two people. So the insurance company can pay a lot more because they don't have to pay out until the second person passes. So we took $500,000 in that unit of money for a 65-year-old couple that they didn't need to use and turn it into $5.5 million.
Oh my gosh.
So this IRA legacy stuff is exciting. It only works so if you don't need to use that money to live on. So the last segment we talked about converting to Roth IRAs. That's for you while you're alive, you and your husband, Cynthia. Let's do the Roth conversion. But if they're a part of the retirement accounts that you don't need, let's position them into an IRA legacy for kind of a 1-2 punch. So now you have tax-free income with your Roth while you're living, and now your kids get all kinds of tax-free income on the back end.
Yeah,
this is fascinating.
I know what you're thinking out there. Oh, well, I'm not healthy enough, or my wife isn't healthy enough. Maybe you have some health problems. Don't discount that, because the whole reason to do two people on these policies is that we can usually get it put through.
Yeah, we had one situation where the husband was completely uninsurable because of a heart issue, and his wife was in great health, and the program got a preferred rating, which they value how much you can get in death benefit. So it is a tremendous strategy to avoid taxes, and I think it's a powerful punch when you put a Roth conversion for you while you were alive.
There you go.
And then an IRA legacy for the remaining part once you pass away. You've eliminated taxes across across the board. A couple little nuggets here for today's show. You come in and see us, and we've got some great tax software. We can map all of this out. We look at your actual tax return. We look at your deductions, your income, all of your lifestyle that you have on your tax world, and we put together a strategic plan for you while you're alive and when it goes to your children or whoever your beneficiary is.
Yeah.
It's all coming down to proper tax planning. And Adam, I know you got Uncle Sam on the desk there. We should bonk him on the head because we're talking about removing him as much as possible. Remember, it's not about how much you've saved or how much you've earned, but it's really about how much you're able to keep when it comes to your retirement planning. Adam, wouldn't you agree? How much you keep?
It's what you keep. I'm not.
Well, we had a client that the other day, I don't mean to interrupt you, but they said, I think I've been doing it all show, but anyway, they said to us, tax savings in retirement is more valuable to this person, than a rate of return of an asset.
100%.
Think about that, because he's in a higher tax bracket. If he can save 30, 35, 37%, that is way more valuable than getting 6, 7, 8, 9% return in a stock account.
Most definitely.
And I think once you get into retirement or you get close to retirement, your mind switches more into wealth preservation, and taxation is one of the biggest eroding factors of people's retirement plans.
Wow.
100%.
And they're probably thinking, I pay taxes my whole life. The last thing I want to do is think about this in the retirement years. But Jordan, you know what? It's time to invite the audience to get ripped. Take it away.
One last time to get ripped. So everyone that calls in today or scans the QR, we're going to give you your own customized personal financial plan. A lot of people don't have a financial plan, and that's fine. We'll do one for you. Or if you have a financial plan, what hurts to get a second one? And now Adam's on the phone. But our RIP report is RIPT. The first section is a risk evaluation to make sure that you're taking the right amount of risk that you're comfortable with, not what someone says down the street. Also, to make sure on the income plan, do you have a roadmap that accounts for taxation, stock market loss? Do you have guaranteed income, or is it more of a guess? The P is the portfolio. Do you have a healthy portfolio? What are you investing in? Costly mutual funds or nice smooth ETFs? And lastly, taxation. Let's get Uncle Sam out of there.
Most definitely. Thank you so much, gentlemen. To the viewers at home, thank you for spending time with us today on the Main Money Show, where Wall Street meets Main Street. It's your opportunity to get ripped. Take advantage today. Call in 888-462-7839, or we've made it even simpler. Just grab your smartphone, click on the QR code at the bottom corner of your screen. Be safe, be happy, and be blessed. And remember, it's not about what you earn, it's about what you keep. We'll see you next week. Thank you again for watching.